briefly look into the case law of in the matter of City Equitable Fire Insurance Companies, 1925. In the matter of City Equitable Fire Insurance Companies, 1925. Facts. The company was in liquidation, and it was discovered there was a shortage of funds, mainly due to the deliberate fraud of the chairman, for which he had been convicted. The liquidator brought an action against the other directors of the company for negligence on the basis that they had left the management of the company entirely in the hands of the chairman. Held. The liquidator failed and the judge laid down the duties of care and skill to be expected of a director. A. A director need not exhibit, in the performance of his duties, a greater degree of skill than may reasonably be expected from someone of his knowledge and experience. B. A director is not bound to give continuous attention to the affairs of the company. C. Where duties may properly be left to some other official, a director is justified, in the absence of grounds for suspicion, in trusting that official to perform his duties honestly. The low level of care shown in the matter of City Equitable Fire Insurance Companies, 1925, was raised in. Let us look into the case law of Dorchester Finance Companies Limited versus Stebbing. Dorchester Finance Companies Limited versus Stebbing, 1989. Facts. The company was a money-lending company and had 3 directors, Parsons, Hamilton, and Stebbing. All 3 had considerable accountancy and business experience. Parsons and Hamilton were chartered accountants. No board meetings were ever held, and Parsons and Hamilton left all the affairs of the company to Stebbing. Parsons and Hamilton did, however, turn up from time to time and signed blank checks on the company's account, which they left Stebbing to deal with. Stebbing loaned the company's money without complying with statutory regulations applying to money lending, such that the loans were unenforceable. Held. All 3 were liable in negligence. If a director has a special skill, for example, as an accountant, he is expected to use it for the benefit of the company. Now let us look into the next concept, that is duty to avoid conflicts of interest along with the case law of IDC versus Cooley, 1972. Duty to avoid conflicts of interest, S-175. A director must avoid any situation which places him in direct conflict with the interests of the company or the performance of any other duty. IDC versus Cooley, 1972. Facts. Cooley, the managing director of IDC, had been negotiating a contract on behalf of the company, but the third party wished to award the contract to him personally and not to the company. Without disclosing his reason to the company or its board, he resigned in order to take the contract personally. Held. He was in breach of fiduciary duty as he had profited personally by use of an opportunity which came to him through his directorship. It made no difference that the company itself would not have obtained the contract. He was therefore accountable to the company for the benefits gained from the contract. The IDC case also illustrates that an individual may still be subject to the duties even after he ceases to be a director. The accountability arises from the mere fact of having made a profit. It is not a question of loss to the company. Now, briefly look into the case law of Regal Hastings Limited versus Gulliver. Regal Hastings Limited versus Gulliver, 1942. Facts. The claimant company owned one cinema and wished to buy two others with the object of selling all three together. They formed a subsidiary to buy the cinemas, but could not provide all the capital needed to finance the purchase. The directors bought some of the shares in the subsidiary to enable the purchases to be made, and later sold their shares at a profit. Held. The directors must account to the claimant company for the profit on the grounds that it was only through the knowledge and opportunity they gained as directors of that company that they were able to obtain the shares and consequently to make the profit. Let us discuss the next part, duty not to accept benefits from third parties, along with the case law of Boston Deep Sea Fishing and Ice Companies versus Ansell. Duty not to accept benefits from third parties, as 176. A director must not accept any benefit from a third party which arises by reason of him being a director or performing or not performing an act as a director, unless acceptance cannot reasonably be regarded as likely to give rise to a conflict of interest. Boston Deep Sea Fishing and Ice Companies versus Ansell, 1888. Facts. Ansell was managing director of the claimant company. He accepted a commission, bribe, from a supplier to order goods from that supplier on behalf of the company. When the company found out, he was dismissed. Held. The defendant was in breach of his fiduciary duty as the agent of the company. Therefore, the company could recover the commissions paid to him. Let us discuss the next thing, that is duty to declare interest in proposed transaction or arrangement. Duty to declare interest in proposed transaction or arrangement. S. 177. A director is required to declare the nature and extent of any interest, either direct or indirect, through a connected person, that they have in relation to a proposed transaction or arrangement with the company, even if the director is not a party to a transaction. The duty may apply if they are aware or ought reasonably to have been aware of the interest. This declaration can be made in writing at a board meeting or by a general notice that he has an interest in a third party. Briefly look into the case law of Aberdeen Railway versus Blakey. Aberdeen Railway versus Blakey, 1854. Facts. A company bought some shares from a firm. At the time of the contract, one of the company's directors, unknown to the company, was a partner in the firm. Held. The company could avoid the contract because of this undisclosed interest in the transaction. Now let us look into the next concept of breach of director's duties along with the case law of Percival versus Wright. Breach of director's duties. Directors owe their duties to the company as a whole, not to individual members. Percival versus Wright, 1902. Facts. A director of a company bought shares from a member at a price less than that for which the director knew that a third party had expressed interest in buying all the shares in the company. The third party interest came to nothing, but the selling member sued the director for breach of duty to the member in not disclosing the interest expressed by the third party. Held. The purchasing director was under no obligation to disclose to the selling member the third-party interest. A director's duties are owed to the company and not to individual members. The director may be required to make good any loss suffered by the company. Contracts entered into between the company and the director may be rendered voidable. Any property taken by the director from the company can be recovered from him if still in his possession. Property may be recovered directly from a third party unless that third party acquired it for value and in good faith. An injunction may be an appropriate remedy where the breach has not yet occurred. S 232 CA06 provides that any provision to exempt a director from or indemnify him against any liability for breach of duty or negligence is void. S 239 CA06 states that the company can ratify a breach of duty by passing an ordinary resolution.